Most people treat tax as an expense, something unavoidable, something deducted along the way. But structurally, tax is something else. Tax shapes compounding, and compounding shapes long-term outcomes. Tax and compounding. Small differences in effective tax rates, sustained over long periods, create surprisingly large outcome differences. This effect is often called tax drag. Tax drag is the reduction in investment growth caused by taxation. It operates quietly, year after year, often unnoticed. A simple illustration. Let us examine a simplified example. Two investors begin with £100,000. Both achieve 7% annual return before tax. But their effective after-tax returns differ. Investor A experiences tax drag that reduces their net return to 5.5%. Investor B operates within a structure where the net return remained 6.8%. Now observe what happens over 15 years. At 7% gross return, £100,000 grows to approximately £276,000. At 6.8% net, the same capital grows to roughly £268,000. At 5.5% net, it grows to approximately £223,000. The difference between 6.8% and 5.5% over 15 years? Approximately £45,000. The starting capital was identical. The discipline was identical. The difference was structural. Now pause for a moment. If your effective long-term return were reduced by 1 to 1.5% per year, what would that cost you over 20 years? Tax drag compounds. Not emotionally. Mathematically. Structural efficiency. This discussion is not about aggressive tax avoidance. It is about structural efficiency. Tax-efficient architecture may include using tax-advantaged investment accounts, holding globally diversified investment funds, optimizing asset location across accounts, separating income-generating assets from long-term growth assets where appropriate. Legal structure shapes long-term outcomes. Tax stability. There is another dimension that often receives less attention. Stability. Tax systems evolve. Rates change. Rules change. If capital gains rules shift suddenly, long-term projections change. If dividend tax increases, net yield declines. So stability matters almost as much as rate. Now reflect quietly. Do you understand your effective long-term return after tax? Or do you only know the headline return? Headline returns can mislead. Architecture requires net awareness. The objective is not to minimize tax at all costs. It is to avoid unnecessary structural drag. Over decades, small improvements in structural efficiency produce large compounding differences. In the next episode, we examine capital controls and access risk, because even tax-efficient capital can become vulnerable if access to it becomes restricted.